and it remained in surplus. Given these conditions, the Reserve Bank mainly conducted variable rate reverse repo operations, that is VRRR operations, to absorb surplus liquidity. To alleviate temporary liquidity tightness because of large GST outflows, however, fine-tuning variable rate repo operations, that is VRR operations, were conducted intermittently during October and November. The two-way liquidity operations of the Reserve Bank ensured close alignment of the interbank overnight rate with the policy repo rate. Transmission to the credit market has been satisfactory. As you would have noticed, as in the previous monetary policy statements, lot of data is given in the footnotes. So those of you who are interested may have a look at the footnotes, because the data in the footnotes justify and back up whatever I am saying as a part of my statement. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL, and this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th. This will restore the CRR to 4% of NDTL, which was in fact the prevailing rate before commencement of the policy tightening cycle in April 2022. The reduction in CRR is consistent with the neutral policy stance and would increase primary liquidity of about rupees 1.16 lakh crore, that is 1,16,000 crore, to the banking system. Going forward, the Reserve Bank will continue to be nimble and proactive in its liquidity management operations to ensure that money market interest rates evolve in an orderly manner and the productive requirements of the economy are met. During 2024-25, that is from the period April to November, the Indian rupee depreciated by 1.3%, largely due to pressure from strengthening US dollar and selling pressure by foreign portfolio investors, especially in October and November. Nevertheless, both the depreciation of the Indian rupee and its volatility was less compared to its EME peers. And this reflects India's strong macroeconomic fundamentals and improvement in the external sector outlook. The Reserve Bank's exchange rate policy has remained consistent over the years, and it is market determined. Its central tenet is to maintain orderliness and stability without compromising market efficiency. Foreign exchange reserves are deployed judiciously to mitigate undue volatility, maintain market confidence, anchor expectations, and preserve overall financial stability. These interventions focus on smoothing excessive and disruptive volatility rather than targeting any specific exchange rate level or band. At the same time, our effort to deepen and modernize the foreign exchange market have also yielded significant results in terms of, first, widening access and participation, and second, ensuring efficient price discovery. Our overall approach ensures that forex reserves act as shock absorbers, safeguarding the economy from external spillovers, while supporting competitive and orderly market conditions. The flexible or market-determined exchange rate regime is not merely a tool for managing external shocks. It is an important element of our approach to macroeconomic and financial stability. By combining market discipline with prudent intervention, We have created a system that supports stability, resilience, and growth. Let me now focus on financial stability. The financial parameters of banks and NBFCs continue to be strong. The incoming data suggest that the gap between growth of credit and deposits of scheduled commercial banks has narrowed, with deposits keeping pace with loan growth. In fact, on the financial sector, I can say with confidence that I think the health of the financial sector today is perhaps at one of its best in a long time. The Reserve Bank supervision of the financial sector and its entities continues to be vigilant and proactive. Incipient signs of stress, if any, either at the systemic or entity levels, are monitored closely and proactive action is initiated. The effort is always to resolve the issues non-disruptively. Continuous engagement is held over several months, sometimes even exceeding 1 year, with the regulated entities. Only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. In fact, there are a large number of entities where the corrective action is taken and where we simply do not take any action because the response by the regulated entities is found to be, very proactive and, very responsive. And so in many cases, without imposing any restrictions on their business or other kinds of activities, the problem gets resolved. Obviously, the list is not known outside. That list is much longer. And the total number of entities, I'm not being defensive about it or in any way. Why I'm emphasizing on this is that this is something which we have to do in the interest of stability of the system as well as the stability and health of the individual entities. So only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. To address the issues of unclaimed deposits, inoperative accounts and frozen accounts due to pendency of KYC updation, banks have been advised very recently once again to take necessary steps urgently to bring down the number of such accounts and make the process hassle-free. Further, banks have been advised to segregate the accounts of beneficiaries of various central and state government schemes through direct benefit transfer, that is DBT, and facilitate uninterrupted credit of the DBT amounts into their accounts and also utilization of the DBT amounts by the account holders. And we have advised the banks to do it without inconveniencing such vulnerable segments of customers, because the DBT beneficiaries are usually, and they are the vulnerable sections of the society. So being fully mindful of that, we have emphasized that there should be a kind of a seamless and smooth flow of DBT amounts into the bank accounts of such individuals in a situation so that it facilitates, the individuals to withdraw the money to meet their various requirements. Progress made by individual banks in this regard will be monitored by the Reserve Bank. I would now like to turn to the external sector.